Welcome back to the Live Off Rents podcast by Spark Rental. As always, I'm your host, Brian Davis, co-founder of Spark Rental, and I am on a journey to reach financial independence with a group of other investors in our co-investing club. I invest my personal money every month in these various real estate investments that we do. They're all hands-off investments. And part of the fun of our co-investing club is we get to bring in outside experts to come and speak to the club every month, in addition to vetting deals together. And some of those experts come and speak on the podcast, which is fun as well. So today we are breaking down the risks and rewards of self-storage investing with our guest, Chad Zdenek. He holds not one, not two, but three master's degrees, if you can believe that. He's a licensed general contractor, professional engineer, and he's the founder of CSQ Properties, which does, of course, invest in self-storage in addition to multifamily. So on that note, Chad, tell us about some of the risks and rewards of self-storage.
Hey, Brian, thanks for having me on the show. I appreciate it. So yeah, self-storage is great. You know, one of the phrases that we like to talk about is you're managing boxes instead of tenants. And there's a lot to be said for that, especially in this world where things are changing a lot on the landlord side for multifamily. But with self-storage, you don't have what you might call regulation risk or legislative liability with the rules changing as much. The eviction process, if you have a non-paying tenant, is super simple. From a construction standpoint, the buildings are super simple. Tenant turnover is much easier than you would have on multifamily. You know, you basically sweep it clean and good to go. You could get tenants out, non-paying tenants out in as early as 30 days. You have an auction of the material, and literally within 60 days, you have a turnover with minimal cost. So from a financial perspective, it's a lot easier than it would be in multifamily. And I invest in multifamily and self-storage. Those are my two asset classes that I focus on. But that's not to say there aren't any challenges with self-storage. In particular, you know, self-storage has done really well through COVID, and even before COVID, it's always done really, really well. In fact, right now is probably one of the more challenging times for self-storage for a couple of reasons that we can get into that we haven't seen in a long time in self-storage. So part of that is from overdevelopment. Like, self-storage has done really well, and there's been a lot of development of self-storage. So depending on your markets, there could be some oversaturation in some areas. The other thing that I didn't realize as much, and frankly, I don't think many operators realized, is how correlated self-storage is to the single family market. And as you know, as we've had the run up in interest rates and transaction velocity, you know, meaning the sales that you have on the single family side has really fallen off a cliff. We're down about 70% from where we were 18 months ago on transactions, meaning, you know, the number of houses that are being sold on the market. And that's really put a lot of pressure on self-storage, because one of the types of customers that use self-storage frequently are when people are moving between houses. So they might be upgrading or downgrading, but there might be, you know, a few months where they need to have some extra storage when they're in between places, or when they're staging places to a new place they're moving to. You know, during COVID, we had a lot of people moving in different areas, right? You had a lot of states without migration, a lot of states with in migration, and that was really, really good for the self-storage market. But now that people aren't moving as much and they're not selling their houses as much, that's really affected self-storage a lot. So we're finding that we're having to pivot quite a bit to make adjustments to keep these properties cash flowing.
Well, I've got several questions for you, but let's start with what you just touched on in pivoting in a challenging market environment. So, how have you guys been pivoting as self-storage operators to keep your cash flow positive?
Yeah, so I think part of it, a few things. When you talk about a value add deal for multifamily, a lot of people know what that means, right? Like improving places and raising rents. But there's also value adds in the self-storage space, which more typically happens to do with expanding your existing net rentable space. So let's say you buy a 5-acre property and you've got a few 100,000 feet of net rentable space on there, but you've got a large like parking lot adjacent to it or just land, right? You could create more units on that adjacent land, that's the value add part of your project. But what we're working on now is we're actually working on bringing in storage containers to reduce our development costs and the development timeline. So we're ordering these basically shipping containers, different sizes, but bringing them on, and you just put them on the adjacent land, and you can rent those up really quickly for minimal cost. So that's one way that we're doing a value add proposition on these self-storage properties.
I love that. That's very creative. And you're one of the first storage operators I've heard use that strategy of bringing on, just installing a bunch of storage containers and renting those out. Um, yeah, it's interesting. In the Great Recession, storage was one of the few types of real estate that maintained positive returns. As we all remember, real estate really just went into the gutter in the Great Recession and its aftermath. But storage did well. So, everyone took away this lesson that, oh, self-storage is the ultimate recession-resistant real estate investment. But, like you said, it's led to some oversaturation. A lot of developers have overbuilt self-storage facilities, not in every city in the US or every market, but in a lot of cities in the US. So one question I have for you before we wrap up is, how do you protect against that risk of oversupply of new development in your market? Because you're planning on buying these facilities and holding them for 3, 5, 7 years, whatever it is. But people can put up these storage facilities very quickly, given how simple the construction is for these. So how do you protect against, you buy a property of a storage facility, how do you protect against someone else just putting up another facility across the street, within a year of you buying it?
Yeah, and that is a challenge. And there's a lot of different strategies you could go with on that. Depending on where you are buying or developing. Some places in these primary markets, it could actually be really difficult to get the land zoned appropriately for self-storage. And that could be a barrier of entry, so that it's going to be very difficult for someone else to build a self-storage area in your vicinity. So that's one way that you could kind of deal with that challenge. They say that the 2024 is the year of the operator. And what that really means is that operations really, really make a difference right now. If you are buying, depending on the asset class, let's say from 2014 to 2022, like you could just basically buy and kind of ride the wave and do really well. And
Yeah.
there's a lot of operators that appeared to be doing well during that time, but it was really market driven than it was the operator themselves. Whereas in 2024, like, you've got to operate really well if you're going to be getting any sort of cash flow from your property. So I would say operations are critical during this time. And the last thing I'd mention, seeing that we have experienced the softening of self-storage, which is the first time in at least 20 years we've seen a softening in this asset class. We're reminded that real estate is a long-term investment, right? And sure enough, the same is true for self-storage. Even if you looked at mobile home parks when they were selling at 10 caps, like 10, 15 years ago, like no one wanted a mobile home park, even at a 10 cap, 12 cap. And you see how much that's compressed over time. But one thing I think that's always stayed true is that real estate is a long-term investment. And you've got to have a long-term horizon when you're looking at it. You've got to match the debt with that long-term horizon and have a business plan that really helps to exploit it. And when you put all those things together, real estate continues to be an excellent investment vehicle. But you got to understand that sometimes you got to ride out some of these cycles.
Yeah, no, it makes perfect sense. And it reminds me of that Warren Buffett quote, when the tide goes out, you can tell who's been swimming naked.
Yeah.
How, yeah, from 2014 to 2022, it was just a big party in the commercial real estate industry. And the last 2 years has been the hangover from that party. So anyway, I love that. Chad, in 30 seconds or less, how do you help people and how can people connect with you if they want to take you up on that help?
Sure. Yeah. So I'm basically a commercial real estate syndicator, pooling investments together. We work with larger investments, typically 75K or 100K minimums, but we do that for multifamily and self-storage properties. And best way for people to reach me is anywhere on social media is at CSQ Properties, like challenge status quo, or email is info@csqproperties.com.
Awesome. Well, Chad, thank you so much for joining us today. And guys, if you enjoy these quick, focused conversations that we have, please rate, review the podcast. It makes a world of difference to us. And on that note, we will catch you on the flip side. Want the cash flow appreciation and tax benefits of real estate without becoming a landlord? You've heard of REITs and real estate crowdfunding, but you probably don't know much about 5 other ways to invest passively in real estate. So we put together a free video course for you to show you how to consistently earn 15% plus returns from 5 lesser known hands-off ways to invest in real estate. And even more importantly, we'll keep risk front and center in that whole discussion. Because really, what's the point of investing for high returns if you also take on high risk, right? So visit sparkrental.com/free to take our free course. Each video is snackable at 10 to 15 minutes long, and the entire course takes less time than watching a movie. Looking forward to chatting with you from within the course.